asking about how you are different than other companies. I was going to say our unique investment approach, which is what I heard today. And it's actually very funny to hear that because you feel like, okay, it's very unique, this is what we're doing. But no, I think all these reforms are very good. I mean, our company several years ago, we got much more in passive income for actually the advisors. We have an investment platform, more of an open architecture approach. So we utilize ETFs, we utilize stocks, individual bonds, maybe 5,000 different mutual funds. So we're completely independent. That's definitely where I think the market's moving to something that has a much more of an open approach. So yeah, in terms of when we talk to clients, if they like to be in stocks, we can be very large blue chip companies, a Walt Disney or an Apple. Not everyone wants to have individual equities, but they do pay dividends. And they're still growing, much better than, let's say, McDonald's or even a Procter & Gamble. Disney's still actually doing really well. Actually, today they released their earnings. It should be very good. Apple is still actually undervalued in the market. It's only trading about 16 times earnings. But there are fixed income options. You can do preferred shares, corporate bonds, and of course in the U.S. market, there's actually quite a lot in the floating debt market. So that if you can get about 5 to 6%, and of course if interest rates rise, which they will because they have to rise this year and have to continue to rise because they basically don't exist, they'll reset 90 days. But it is hard to find that kind of holy grail of income without risk. And this would be the same kind of level of debt or it would be grade bonds. But definitely the bond market's not going to be an attractive place to be.
Yeah, I mean, maybe a bit earlier than I thought if we go on to talk about investment views, before one question I do want to ask, and I'll ask you last about robo-advice. We've had a lot today, Angus apart. It's multi-asset, there's no value in bonds. Property securities are great. If you like bricks and mortar, long-term, lovely, but equities, the US is expensive, Euro is expensive, the UK is expensive. Where's the value? Where do you start building a portfolio, a growth portfolio, when there's very little growth anywhere? And where there is, in the US and the UK and even the JSE here, all of the races are all hitting all-time highs. Where can you look for growth and for value?
Sure, there's a lot of places to look for it. In the ETF market, no one really saw oil decreasing so much over Christmas. All the airlines are up, doing very well. There's even an ETF called JETS, J-E-T-S, in the US now. I'm not saying the airlines are a good industry, but you have to be industry specific. Obviously, leisure has done incredible, again, because of the price of oil. Also, healthcare, biotech, even though it's more overvalued, is kind of a long-term trend. And the US market's actually trading the same as it was the last 3 years. I agree that it's definitely on the top, and it's good that people are bearish and things are slowing down. But at the moment, I think kind of the sweet spot is mid-cap. One of the speakers, obviously that fund, I mean, there are companies like Skyworks, which is a chip maker, that supplies chips for Apple and Samsung. They were in the Russell 2000 as of December. They were about an $11 billion company. They're now a $17 billion company. So trends like the Internet of Things. So right now there's about 15 billion devices connected. I know we're all connected, but in 5 years there'll be 40 billion devices. So your grill will be activated, your thermostat at home, much more so than just your tablets. So there's ways to play those trends, I think. And of course there's always emerging markets as well. But it is, I mean, a lot of people are looking for value in oil. I typically think it's a bit of a value trap, depending on what you're investing into. Like a Chevron is obviously a great company, is going to do well, but some smaller companies have actually estimated oil at a much higher price. So I think you just have to kind of look at all of it together.
I say it's very specific. I mean, let's narrow it down to the equities. Where are you seeing opportunities right now?
I agree with Warren. I think at this point in time, at this point in the cycle, the downside risk is probably higher than the upside risk. It goes without saying, really. But there is probably pockets of growth if we're very selective, like the examples you mentioned.